Very good morning, everyone. I'm Axel Threlfall. This is London Climate Action Week Finance Live. Coming up on today's programme. Climate cooperation, the UK and China launch a new report on future transition planning for companies and governments. On another day of extreme heat in the UK and Europe, we'll talk to the leading climate scientist, Professor Jim Skea, about his priorities for meaningful action. We'll report from London's Kew Gardens about its role in promoting our understanding of the value of nature.
I absolutely love what's been achieved with London Climate Action Week. It's exactly what we should be doing, bringing together the global debate on this. So this is about raising awareness, building excitement and unlocking investment.
Plus, nature as a solution to the economic fallout from climate change. So a busy show this morning. Morning, everyone. Welcome to our final show of the week, brought to you in association with London Climate Action Week, LSEG, the Green Finance Institute, and of course, Reuters. First today, the UK and China have been marking the two countries' cooperation over the transition to low-carbon economies. A new report is being launched by LSEG, the City of London, China's Institute of Sustainable Finance and other Chinese financial organisations. It looks at how companies report on their climate and policy frameworks and says that while the UK and China have adopted distinct approaches, there are opportunities for synergies in scaling green and transition finance. FTSE Russell, which is part of LSEG, and the China Construction Bank are also launching a new FTSE China Index, which tracks the performance of China offshore green bonds that can be used to finance green projects in China. Representatives of both countries attended a ceremony to mark their cooperation here at the London Stock Exchange, where the World Climate Investment Summit is also taking place today.
I'm honoured to welcome today the UK-China Green Finance Task Force and co-chairs Dr. Ma Jun and Sir Charles Bowman to today's market open ceremony. I'm especially pleased to showcase two practical examples of bilateral cooperation in action. Firstly, the launch of a new member-led research report on UK-China collaboration on transition finance and the green economy that was led by LSEG in collaboration with IFS, Bank of Jiangsu and HSBC. Second, as the CEO of FTSE Russell, I take particular joy in announcing that FTSE Russell and the China Construction Bank have reached agreement to launch the FTSE CCB Dim Sum Offshore Chinese Yuan Green Bond Index, developed through very close collaboration. This new index will offer a transparent, rules-based benchmark that is designed to measure the performance of offshore renminbi-denominated dim sum green bonds, supporting investors' access to what is a fast-growing segment of the global fixed income market.
Going forward, we'll be pushing more on decarbonization in many fronts, including decarbonizing some of the buildings in China and utilizing China-UK expertise, both on technology, on finance, and on design expertise. And really looking forward to work with our UK teams, led by Sir Charles, on so many issues, right? Transition, nature, and probably the third market, including developing country, emerging markets on capacity building, technology transfer, and financing that transition. Thank you very much.
Right, let's hear from two of the people you just saw up on that balcony, the co-chairs of the UK-China Green Finance Task Force. Dr. Ma Jun, founder and president of China's Institute of Finance and Sustainability, and Sir Charles Bowman, director of the China-Britain Business Council and former Lord Mayor of the City of London. Welcome to both of you. Really nice to see you again back on the show. And let me start with you, and we will start with the Finance Task Force. Is it doing what you hoped it would do in terms of collaboration and the sort of traction you're getting on transition finance?
Well, thank you very much for having us. Maybe I'll start with a little history of the China-UK Green Finance Task Force. It started in 2017, so it's been 9 years already. And even before that, the China-UK began to collaborate on green finance in the form of co-chairing the G20 Green Finance Study Group. So it's a long history. And over 9 years, we have done many things, including applying TCFD, initially called, then it's ISFP, in the range of Chinese financial institutions. And we, in the last couple of years, began to develop the transition finance It's called Workstream,
Yep.
and which is fairly productive, including one of the reports which are publishing today, and also the Nature Finance Workstream, which are now actually promoting TNFD adoption in the world, and of course through the Chinese financial system.
Yep.
And decarbonization is definitely the big thing for most of the workstream. And one of the initiatives that we are pushing is, in fact, using both China and UK expertise, for example, finance, design, technology, to do pilot projects in China on decarbonization of buildings.
Okay. So you're happy with the progress, is what I gather from that since 2017.
I'm looking forward to more progress.
Yes. Okay. So Charles, I hate to say it, but clearly this is more than a diplomatic talking shop. Give us a sense of the sort of concrete, measurable outcomes that we've seen from this collaboration.
All manner of activity, and as Dr. Mars says, just to put some context around it, it has been 9 years, well, 10 years in the making, 9 years in the execution. I took over as chair in March last year, and we saw from that, and that was 2 months after the economic financial dialogue, the first for a few years. In fairness, but as part and parcel of that economic and financial dialogue, a policy outcome including 69 paragraphs of activity, green finance accounted for at least 10 of those paragraphs.
Yep. Really
Important steps in that. So through the course of this year, by way of example, we've developed two new work streams, one on transition finance, and you've heard 2 reports out only this week, one on nature and biodiversity, and a working group in relation to green bond issuance here in the UK. So lots of progress, more to be done.
In terms of what we here in the UK and indeed here in Europe can learn from China and what China can learn from us, how's that working now? Are we getting more out of this than they're getting from it?
I'll let Dr. Ma answer part of it, but I think it's a very nice balance of collaboration between 2 countries. And one of the things, by the way, I should say thank you to London Stock Exchange for hosting us today for the market opening, because one of the things, Axel, that I think is really important around this agenda is to be able to communicate it, the agenda, the outputs and the outcomes beyond the echo chamber. It's a really important point, this. UK and China have different strengths. We collaborate well together, and therefore we're seeing 2 and 2 equal more than 4 in large part. And that's where I think other countries can learn. In a world where it's looking increasingly multilateral too, engaging other countries, developing countries is an opportunity too.
That, just to the point of China, UK has their own strengths, and it's very complementary in the sense that China is a leader on the real economy, for example, the manufacturing of renewables, electric vehicles, batteries, and so on. UK, especially London, is a leading global financial center. So what you need in the global climate action is a combination of technology and finance. And jointly, if we can...
And that's what's happening here. Okay.
That's what's happening bilaterally. And also in the third markets.
Where, horribly journalistic, sort of geopolitical journalistic question I'm going to ask now, but in terms of the context and whether we're talking headwinds in trade, different positions on Russia and other hotspots around the world, how has that complicated a relationship like this?
Well, look, the Green Finance Task Force was set up in 2017, as Dr. Mars said, probably at the back end of what was coined the golden era. In fairness, what it has been very effective. The bilateral relationship, I think we can all recognise, had a cooling off period, China-UK, in the period after that. But what this pivotal platform was able to do was continue the business-to-business engagement through that period of time. Okay. Really successfully.
But there is an increased wariness? Would you agree with that? There is an increased wariness in terms of the relationship between China and Europe?
I think what we've seen over the course of the last 24 months is considerable progress mature progress in terms of that relationship. We saw that came to a high, not least in January this year, with the Prime Minister's very successful visit to China.
If I may add, I think in this particular area, which is the green finance, climate finance, it's largely depoliticized. Despite the geopolitics globally, sometimes between China and UK, which makes certain issues more sensitive, right? But financing sustainability, especially climate action, decarbonization, largely stays out of that. And that's why we were able to continue the effort under China-UK Green Finance Task Force throughout last 9 years, with no disruption.
Okay, well, that's good to hear. In terms of what's going on the ground in China, I mean, we talked about this last year, and the competing regional standards and the competing guidelines in China. I think there are about 22 different standards. When can the markets, when can investors expect a single enforceable national standard, if indeed you think that's realistic in China?
Now, let's talk about the different standards, right? Within a country as big as China, we actually started with a couple of green finance definition in China back 10 years ago. I was the guy who actually led the drafting of the Green Bond Standard 2015. But during that time, we have 2 or 3, coming from different, regulators and so on. But eventually, it consolidated into one green finance taxonomy. That's the situation now. Now, what you're referring to may be the transition finance taxonomy, which we're new.
Because yes, that is what I'm referring.
This is how we define transition activities. The origin was, in fact, 2022, when China was a co-chair of the G20 Sustainable Finance Working Group, and the group came up with a transition finance framework, and China adopted the framework. We began to encourage local governments to put out their local standards, because a national standard would take time and need to really learn from the lessons that's being accumulated at the local level. That's why we got 20 plus regional governments coming up with their transition finance standards or taxonomy. And now it's in the process of gradually getting consolidated at the central bank level. That's a domestic thing, but internationally it's more important to move towards interoperability, which was the effort of a China-EU-led common ground taxonomy. And it's being quite used already in the market by sort of labeling some of the international transactions with the CGT aligned.
You're here for, just to finish up with you, you're here for the whole week. What have been some of the most fruitful conversations that you've had this week? Is it more with the investors, or is it more with the policy side?
Maybe give a couple of examples, because I'm attending like 20 different events. Yesterday we had a good conversation in London School of Economics on transition financing in China, transition financing UK, and transition finance for Africa. So the conclusion that for transition finance, we should allow a lot of local context. Right? UK is probably focusing on building, on aviation. China is focusing on steel, cement, and Africa is focusing on food and energy. And there are different priorities, and we need to allow that kind of flexibility. That's one piece of the discussion which is useful. The second one was CASI. It's called Capacity Building Alliance of Sustainable Investment, which I initiated back 2.5 years ago, which is a consortium of 73 organizations providing training and capacity building to the global emerging markets. And UK is a big part of that. Out of 70-something organizations, 20 are UK-based.
Final word, Sir Charles. Are the policymakers here in the UK on board?
They're listening. But we can be, I think, the observation, I come back to the point I made about advocacy and communication. I think we can all, beyond the ecosystem, echo chamber, I think we can all be a little bit braver in terms of communicating the value of this agenda, the importance of this agenda as we progress.
Very good. Very diplomatic way of putting it. Thank you. Thank you very much indeed, Sir Charles. And you're nice to see you again as well. Right, stay with us. We've got lots more to come on the show. We'll be hearing from the director of London's Kew Gardens about its role in conserving nature and the value of nature as an asset in responding to climate change. And we'll continue that theme with the conservationist Dr. Harvey Locke, Marissa Drew, Chief Sustainability Officer at Standard Chartered, and Tony Dulwood, Chief Executive at Gresham House. It has been pretty warm, to say the least, in London this week, and there have been warnings recently that we could see a super El Nino later on this year. That is a phenomenon that could make weather patterns more extreme than normal. Building on the outcomes of COP30 and looking forward to COP31, the intersection of capital markets and climate ambition is key, as it'll determine whether climate goals translate into real economic change. The global climate target in the Paris Agreement is to limit global warming to well below 2 degrees above pre-industrial levels, trying to cap the temperature increase at 1.5 degrees. The world is currently on a trajectory toward a 2.3 to 2.5 degree temperature rise by the end of the century. Earlier this month, the World Meteorological Organization said the El Nino weather pattern was forming, with scientists warning climate change would make its impact especially severe, causing extreme weather. Despite the current US administration's skepticism of climate regulation, prioritizing economic growth and fossil fuel production, businesses recognize climate change as a financial and operational risk and are working to reduce emissions, utilize renewable energy, and focus on net zero targets. Right, we're joined now by Professor Sir Jim Skee, Chair of the Intergovernmental Panel on Climate Change, and Saka Nusseibeh, Chief Executive of Federated Hermes. Great to see both of you. I mean, very, very timely. Let me start with you, Jim. How many, and you know, without wanting to sound cliched, how many people have said to you this week in this heat, you did warn us?
Yeah, well, it's been a major topic of all the conversations. But just to say, just because the day is warm does not mean that you have complete evidence about climate change.
Quite good. I'm glad you say that. I'm glad you say that.
Not just one heat wave, but if we look at the overall pattern, the frequency of extreme events, their intensity, and the gradual increases in global temperatures, it's very clear we're on an upward trend, and we are about to cross the threshold of 1.5 degrees.
And I was going to say, you know, I think that they're saying it's a 70% chance now, or probability of breaching 1.5 over the next 5 years. Is it time for the IPCC to explicitly tell governments that 1.5 is no longer a realistic goal?
Right. We are not a 24/7 organisation. We're only 7 in the sense that we produce our reports every 7 years. So we're working on it at the moment, but it's clearly updating our methods with the data that's available. I think I'm using the formulation, it is almost certain that we will cross 1.5.
Yeah. Is there enough of a realisation, though, just before we come on to you, is there enough of a realisation at the policy level that this is where we are?
I think there is actually, obviously with 1 or 2 exceptions, but I think the message has got across. We heard the UN Secretary General's speech earlier in London Climate Action Week. It's fully acknowledged at the UN level, international level, most governments, that we are on our way to much higher temperatures.
Saka, is the finance sector stepping up on this agenda, do you think?
I think it is. I mean, not equally and not in the same way. Let me just say 2 things about the financial sector. One is we have 75,000 people in London Climate Week. It's a big number. It shows there's an interest. I think even those who are naysayers understand that A, it's a mega trend, and B, there are risks even if you can't see the rewards. And that's the key. It is a mega trend. And it's a megatrend because the war in the Middle East has shown how it is of strategic importance. Note that China, for example, survived it much better than others thought because it has already electrified a large part of its grid, so it's become political. It's a megatrend because the price of oil has re-accelerated, for example, the shift to EVs, which people have gone on about. The expense of trying to cool and warm our houses drives us more towards using different kinds of energy sources. All of these things are long-term megatrends. And even if you do not want to believe in what's happening as a result of human intervention, I'm talking particularly about colleagues from some parts of the United States, it doesn't matter. It's happening. And because it's happening, you have to change with it.
So with all that in mind, and you know, as for investors, the question has to be how you incorporate these sorts of risks, not just the climate risk, but all of those mega trends into your investments, into corporate engagement in general, and how agile you need to be, because this stuff changes pretty quickly.
It does. And I think there's 2 things. In investments per se, which is what we do, first you have to know what the position is. I mean, TCFD sort of helps you, gives you a first glance. The second one, then you have to work out for every single company you invest in, other specific risks. We just saw a clip on the screen a minute ago of risks in supply lines of floods, risks of fires and so on, and perhaps risks of breakdown of supply. But there's also opportunities. That's the second thing you've got to look at. Let's flip that over. We also represent some 2 trillion in assets where we engage. EOS was is the earliest engager in the market. There we have a much longer engagement span with companies, typically over 10 or 15 years. And with them, we talk strategically. We can see this trend. It's almost inevitable we're going to cross 1.5. It's going to affect business. So how are you making a business resilient to that?
Jim, I know you're not in the finance sector. You sit on the outside looking in, but clearly that the collaboration is critical. Do you feel the sector stepping up? Do you see the money moving, and is the money moving into the right places?
Yeah, and just to say, we do actually have finance chapters in all of our reports on both mitigation and adaptation. And it's very clear the money is starting to move, especially on the emissions reduction side with renewables, electrification that have been mentioned. And there's a very clear signal because we have a price of carbon effectively out there. One of the things I would want to flag is that there's a much greater need for investment in adaptation and building resilience to the climate change that is now inevitable. And there's only a very small proportion of the money moving there is accounted for by private capital. And I think it's one of the big messages that is going to come out of our next report is going to be about the role of the finance sector on the adaptation.
So get more private money into the adaptation piece.
Yeah.
And how, I mean, we've talked quite a bit about that this week, and we've talked quite a bit about blended finance and catalytic funding as well. How do you do that? How do you get that private money into adaptation? I mean, because it's about bankable, scalable projects, isn't it? That's what the money people want to see now.
So I think that we were having a discussion about this yesterday, and I think you're going to hear one guest that I saw outside who might come with that. You need a system change, so to speak. The easy way of doing it is to say businesses themselves, the big companies, will do some of that because it is in their own interest. You know, builders who build will have to have adaptation into their buildings. Companies that have factories will have to have dedicated money going to adaptation that is perhaps communally based, are harder to get money through unless you get some kind of cooperation of blended finance. My personal view, let's revive the mutual model for citizens and governments.
I mean, it is something we've been talking about for a while, isn't it? I mean, how to get that money. I mean, one of the best comments I heard was from Bill Winters at Standard Chartered, where he said, look, you know, if we don't move in this space, you know, half of our clients around the world are going to be underwater in 50 years.
Yes.
So we need to move here. Yeah.
Absolutely.
So it's more of that argument, but it's more about putting that into practice and getting your fund guys and your money guys and your market guys to see the value in that.
So certainly it is exactly what we engage with companies and talk to companies that we invest directly in about doing for their businesses, because the argument that you had is exactly the right argument. The businesses will lose their client base, will lose their supply lines, will lose their production lines. That's how they will. Now, where the problem comes is, what about adaptation that is not affecting business, but affects the community? And how do you get money there? And what about emerging countries? And how do you get money there? And that's the difficult question.
Yeah, globally, I think one of the most cost-effective investments is in early warning systems for climate-related disasters. And if there's any way of moving private capital towards that, it would be a big advantage. Because clearly transport providers, for example, airports, etc., take the benefit of these early warning systems. And if there's some way of incentivising the movement of money, that would really help us, I think.
Jim, you must get a little bored of being asked about the US withdrawal from IPCC and the UNFCCC and the impacts that has had. But it is real, and there's a lot of money there. There was a lot of money there that isn't there anymore. How detrimental has that been, and will that continue to be?
Well,
really?
I think the answer is it's too early to tell at the moment. You know, it won't affect our current assessment cycle at the moment because we don't do research. We assess findings that are already out there. So it's going to take some time for things to trickle through. But there is a lot of diversity. I mean, Europe's putting a lot of money into climate research. Also in all of the East Asian countries, China, Japan, Korea are also big investors. I think the one bit that we may be concerned about is collecting data from the oceans because actually it's an interconnected system. It's not just the air, it's the oceans as well, the way they interact with each other. And we do need to collect the data to understand what's happening.
Yeah, all right. Look, I've got to stop it there. Thank you so much to both of you there for coming in. Fascinating from both of you. To Jim and to Saka, thanks. Today is officially Nature Day at London Climate Action Week, which focuses on putting nature and biodiversity at the centre of the wider financial system. One of the organisations taking part is the Royal Botanical Gardens at Kew in West London, home to one of the world's largest and most diverse collections of plants and fungi. It serves as a global hub for research and conservation. Our reporter Erin O'Toole has been there to talk to its director, Richard Deverill.
10 miles from London's financial centre, the Royal Botanical Gardens at Kew have become one of the world's leading centres for plant science. Hundreds of scientists work here, identifying new species, preserving those at risk, and developing nature-based solutions to limit the impact of climate change. With nature playing an increasing role in investment, economic and corporate decision-making, this year Kew Gardens has become the backdrop to Nature Day, a dedicated one-day nature finance-focused programme within London Climate Action Week.
Nature Day is the one dedicated day around nature. It focuses policy makers and financiers on the importance of nature as a vital tool in solving the climate crisis.
Richard Deverill became director of Kew in 2012 and has since led a refresh of Kew's strategy, bringing its global scientific expertise into sharper focus.
There's a reasonable scientific consensus that nature, broadly defined, can address about a third of the carbon drawdown and the mitigating actions we need to see. And of course, all life depends on nature, but we're experiencing an unprecedented rate of extinctions, and this is the critical decade, according to the UN, for us to address the nature crisis that we face.
Should we be valuing natural systems in the same way we value more traditional economic infrastructure?
Nature is an asset, it's an incredible asset, and I think the challenge is that historically it's been very hard to enumerate the value of that asset. But there's been some really excellent work on natural capital over the last couple of decades, and we now have much more granular evidence that can tell you, for instance, exactly how much carbon is being stored, or the economic value of pollinator services, or the value of tropical rainforests in providing rainfall for crops. There's a real problem, I think, in biodiversity. It's a very complex, messy subject. There's no equivalent of net zero. So a trusted organisation that can actually provide reliable data, including subsoil carbon sequestration, that's really valuable because it gives investors and companies confidence.
Viewing nature as an asset couldn't come at a more crucial moment. Evidence shows biodiversity loss is accelerating at unprecedented rates.
We know that climate change is the third most powerful force now for biodiversity loss or degradation. Any company that relies on natural products that are grown, for instance, should be concerned about this. I absolutely love what's been achieved with London Climate Action Week. It's exactly what we should be doing, bringing together the global debate on this, and anything we can do at Kew to raise the awareness of nature, not as a problem, but as a solution to the wider climate challenge. And there are amazing solutions that we already have. So this is about raising awareness, building excitement, and unlocking investment.
The UN has issued a stark warning. If we don't halt the destruction of our natural world by 2030, we could trigger an irreversible ecosystem collapse, making the work being done here at Kew all the more critical.
While the UN Secretary-General Antonio Guterres was here for London Climate Action Week, he also visited Kew Gardens. He was awarded the inaugural Kew International Medal, presented by the Royal Botanic Gardens in recognition of his leadership on climate change. Richard Deverill said the medal recognised his exceptional influence on the global conversation around climate, nature and sustainable development during his time at the UN and before that as Prime Minister of Portugal.
We must leave the age of fossil fuels behind. By cutting emissions but cutting emissions is only part of the answer. Nature too must be part of it. Our forests, our oceans, our lands and rivers, all the climate steady, cradle life and sustain millions. Yet nature is more than something to protect. It is our greatest ally. We must invest in nature-based solutions that draw down carbon, defend communities, and meet our climate and environmental challenges.
Okay, well, that sets us up perfectly for this next discussion. We've got a trio of guests here, really well placed to talk about this. Dr. Harvey Locke, who also serves as Vice Chair for Nature Positive with the IUCN World Commission on Protected Areas. Marissa Drew, a regular on the show, Chief Sustainability Officer at Standard Chartered. And Tony Dullwood, CEO at Gresham House, which is an alternative asset manager. Really nice to have you all here and you two back. Tony, I am going to start with you. And look, we've talked about politics this week because the political context is important and the shaky domestic situation here in the UK. Everyone's asking, what's Andy Burnham going to do on climate, on sustainability, on this? You said yesterday, and I quote you here, the Prime Minister's quietness on net zero has left a vacuum for the anti-net zero lobby. It's clearly a real worry for you, this.
Yeah, I mean, the long-termism nature that's required to invest in this type of asset class is critical, but also the education of the LP investors is also critical. And therefore, if you have this vacuum and the lack of education, it leads to being filled by something else, and in this case, the anti-net zero. And that is just not justifiable on some of the data. The reality is we need private capital to invest in this asset class. Private capital can make very good financial returns. There is track records to evidence that. And until that education gets out to these LPs, it won't be embraced as an asset class. And when you have a new Prime Minister coming in, they are obsessed with short-termism. This is an asset class that has long-termism with financial returns. And that education needs to happen now in order for private capital to come in, because there's not enough money from the government to support everything it wants to do.
Yeah, OK. Well, let's talk about the private capital with you, Marissa. In fact, let me just ask you first. Okay. There's so much political noise, not just here in the UK, but globally. And we were just talking to Jim about the US and the IPCC and UNFCCC position. Do you just need to block that out and get on with what you do?
Yeah, and yet we're sitting here, all of us dripping. So I think the planet's telling us what we need to do. But we're pretty encouraged. I do think we always have to remind ourselves that my favorite phrase, ROW, rest of world. And rest of world is getting on with it. And that's where we spend a lot of our time as Standard Chartered. You just had Dr. Ma Jiang on. China has put, ready for this, nature in the 5-year plan. Think about that. When they say that, that is a long-term investment that is going to actually receive hundreds of billions of dollars over an intermediate period of time. And by the way, it's not just nature, it's adaptation. So those are two areas of finance where we're spending a lot of our time. And you're absolutely right that we've got great evidence of delivering financial returns, novel financial structures to invest in nature. So increasingly, we're delivering to the LPs very attractive returns, and we're doing something that is going to hopefully keep us into that much more livable planet territory.
Well, let's talk a little bit about how you can demonstrate that the private side could demonstrate that you could be responsible sources of capital. I mentioned Standard Chartered and the views on the adaptation piece. Given your clients are in these parts of the world that might well be
disproportionately affected
50 years from now. What could you hold up, Marissa, as really good examples of how you're getting this done?
Sure. So maybe an example at sovereign level, because this is a big sovereign issue, and to the point that we're all discussing here, one of the challenges that we have right now is the short-term issues that are facing government leaders, right? You're in crisis. So when you look at the priority list of what's on your fiscal budget, nature is pretty low down because it's long-term. So this is the fundamental issue, which is why the private sector has to step in. So one of the things that we've been doing is working with sovereign governments to say, we can help you finance the investment from a private point of view into nature protection. So good example in Africa, Cote d'Ivoire did a very novel structure with us, $200 million sovereign financing that was sustainability linked, had 2 KPIs. One, which is important for the country, which is a decarbonization KPI. So as they shift their energy mix to create resiliency, which we can come on to as well. But the second KPI was a commitment by the government to protect against deforestation and afforestation. The first one of the structures where you had the dual thing of mitigation and nature protection in the same sovereign structure, it went beautifully. Investors loved it. They will make a decent return on that, and you get that outcome.
And that, Harvey, that is what it's about. I mean, you've got to prove these are investable opportunities, right? I mean, in your mind, and there's lots of other stuff I want to talk to you about, but in terms of financial mechanisms that are proving most effective to prove that point, what are they?
Well, if you analyze what an investor's motivation is, so a lot of conversations have been around ESG or charity and increasing that, and that's a finite amount. if you want to get into the money that moves the economy of the world, basically you have to do something on the return side or the risk reduction side. Simple language. On the return side, there's an idea of something called a natural asset company, which is the idea that you invest in nature as the product, and that product, made fungible through a share structure, is like buying a piece of gold or a piece of fine art or something like that that will have appreciate in value over time, as those have. And the other side of the ledger is insurance. And the insurance, so I'm working on a project right now that involves the rain that the Amazon rainforest generates drives a huge amount of economic activity in South America. The loss of that rain, if the forest is cleared more than 20%, is a very high probability. So then you would try to get an insurance project going that has people paying premiums to have insurance or indemnity against that risk and take some of the premium to protect the forest to reduce the risk.
It seems to be that this, two sides to this, the protecting nature bit versus the harvesting nature bit and how you make money from either of those pieces. It seems the former, the protecting nature bit, has had you've had a much tougher time pushing that argument. Why has that been so hard, that bit?
Well, have you spent a lot of time asking that very question, because it's the question. You can make money now restoring nature. What you can't make money now doing is protecting nature. And what we need to do is protect the intact nature that's left as priority number one. And yet all of our activity is restoration, because we can figure that out economically. So our great challenge and the urgent imperative is to make intact nature investable, which is what I was just talking about.
And can we talk about that for a second, just for this natural capital structure? So if you think about, who buys crypto? Crypto coin, the reason that escalated in value is because this perception that there's a scarcity value, right? They're not going to make more of the coin, so you want to get a piece of that. Why is nature any different? Crypto pays you no intrinsic dividend, and yet we all know nature does. Standing in nature helps you. All this sort of stuff. So think about this. We're sitting here at the London Stock Exchange, a progressive exchange. How about we list, through this natural asset corporation, this beautiful piece of unprotected land? You digitize it, you tokenize it, and now everybody can buy a share in nature. Why wouldn't this go up in value over time as less and less of this beautiful property exists?
Agreed. Right? We've got to get that message through.
Conceptual. Yeah.
Great. I mean, I'm going to come to the points here about risk return. There is ample evidence about the returns. So you take forest, you've got 30-year track records that are very, very strong. But then when you go into the risk elements, you've got a situation where when they go into portfolios, actually they're enhancing portfolio construction. So as LP allocators are obsessed with risk return, it's important to do that. So when you insert some of these things, they end up with improved Sharpe ratios, which is a characteristic, a factor which people who are... And this education process is essential, because if once LP allocators get educated that it enhances the risk return, the Sharpe ratios, the fact that there's inflation linkage of, in forestry's terms, 0.6 compared to inflation, or lack of correlation with other asset classes, low volatility, low risk. All right, as soon as they get that risk return benchmark, then you've got a situation which is a very positive one. And that is something that needs educating and into LP allocators.
Marissa, you mentioned China and nature in the 5-year plan. I want to come back to that because, what can we learn from what they've got in this 5-year plan? Because they do make stuff work when they put something in a 5-year plan, and there must be something there that we here, whether in Europe or indeed in the US, can look and say, that's how to do it.
So a couple things. One is, I always say, follow success stories. And China's long-term investment in green tech, look how that's paid off. They are the owner of PV batteries and EV batteries, right? That is a product that the world wants and needs. That was a long-term game, but they stuck with it because they saw the vision of how that was going to create a competitive advantage for the country. Nature is no different. Again, scarcity value construct. Need it. It's necessary, right? There's value creation always born out of necessity. And I think that mindset is something we ought to look to. And I often say, China's game is financing the industries of the future. And don't we want to be a part of financing the asset class?
I mean, I know that the psychology here may be a little bit different, and yes, they play a very long-term game. But Harvey, what do you think we can learn from there? And when you look at that 5-year plan and you look at the bits that might or might not work, what excites you most?
Well, at the highest level, leadership coming from the president, there's the concept of eco-civilization. And the idea that human activities must fit within the Earth system. That's also really good science. It's also traditional cultural value in China. Done some writing on this. And what's so interesting about that is that's just true. And the problem we have in the West is we treat the economy like it's a competing interest with the environment or with society. It isn't. It's the context for everything. And we're degrading that context. We're going to put ourselves out of business. We're going to degrade all capital unless we get ourselves in line with the system that contains the capital and the people that have the capital. And that's just a basic vision understanding of the direction we must go. That's the essence of this nature positive idea, is how do we go forward in a way that lives within the Earth's means and restores the conditions, halt the loss of nature, and reverse the loss of nature?
And you know, without wanting to sound like a doom monger, I mean, the sort of short-termism, whether it's here in the UK or elsewhere in Europe and the US, how do we get the policy side, the policymakers, to understand that what's important, understand that message, and to try and replicate what they're seeing in China?
I would say, first of all, you need to remind them that it's in the interest of the citizens. So, increasingly, if you poll citizens, they are worried about this topic. Right? It may not be the top thing when you're worried about paying your energy bills, but wait till your energy bills and the systems break down and you aren't able to function. I mean, we're talking about financial leakage, we're talking about value leakage of your property, all this sort of thing. Those messages also need to cut through too. So there's the opportunity side, there's also the risk mitigation downside.
You just got to talk the language of the politicians. They want to save money somewhere, and they want consumers to have things cheaper, and they want the consumers to have things with less risk and security of supply and security of whether it's defence or economic growth. All of that is the language of both the consumer and the government. Put it in the language that's right, recognise that there is financial return so private capital can come in. That supports the government balance sheets, which we all know are more than stretched. Put that whole rhetoric together, you then have a narrative that speaks the language of politicians and consumers, and that is critical.
All right,
Could I
that's
also
our challenge.
offer some success
really
cases? UK government has actually been very successful at working with farmers on regenerative agriculture. For the bits where they have provided a bit of incentive, what the farmers are seeing is substantial increase in the crop abundancy. They can sell those crops at a nice price. And that's one of those little tiny interventions where the government's actually had success in this country, outside of the city centre of London. I think telling those stories more often is also helpful.
Yeah. It's always a fascinating conversation, this, guys. And I'm always loath to end it, but, we're constrained on time. So, look, thanks so much to all of you for coming in today. From debt for nature swaps to green bonds, financing climate-resilient infrastructure, investors and conservation groups, are increasingly focused on proving that protecting nature can generate long-term economic value. But the reverse is also true, that nature degradation can have very negative financial consequences. Water shortages could pose significant financial risks in the UK. Housing projects delayed by insufficient supply could cost the economy up to £25 billion over 5 years. That's according to a report by the World Wildlife Fund and the Green Finance Institute. Only 14% of UK rivers are in good ecological health, and all fail to meet required standards. Pollution has disrupted seafood exports, caused the closure of beaches and the cancellation of major sporting events, with knock-ons for tourism revenue. Floods and storms pose material risks to infrastructure in exposed areas. In 2024, UK flood insurance claims hit a record £585 million. And soil degradation alone costs the UK economy up to £1.4 billion annually. I'm joined now by David Craig, co-chair of the Task Force on Nature-Related Financial Disclosures, and Professor Nicola Ranger, Executive Director, Earth Capital Nexus, and co-lead for Nature at the LSE's Global School of Sustainability. Look, thanks to both of you for coming in. I mean, I'm glad that this nature piece is such a prominent part of the show today because it's so critical. Where are we now, Nicola? Have we... David and I talked about this last year. How much progress has been made over the past 12 months since London Climate Action Week last year?
Well, very significant. So our work is all about putting nature into the economic and financial terms that financial institutions and governments need. And on that, the level of understanding in the financial sector has increased significantly. And we're now seeing them moving from understanding risk to really looking at how can they actually invest in this area and actually build that into their decision.
And are we seeing, really properly seeing capital being mobilised? Enough capital being mobilised?
I think Well, definitely not enough
Definitely
capital.
not enough,
Definitely
yeah.
not enough. So, looking at the big finance numbers on this, we're seeing 7.3 trillion going into things that are destroying nature versus only 220 billion going into things that are positive for nature. So we want to see those numbers flipped over.
And this is, we're talking here about the protection versus the harvesting argument. Is that right?
Yes.
Making money from harvesting nature, or are you talking about the destruction of nature?
Well, so I think a big part of this agenda is not just financing more conservation, so that's part of it, but it's also about looking at how can we make our critical supply chains more nature positive, for example, because that's one of the biggest destroyers of nature around the world. Like all our critical minerals, our food, are being done in ways that at the moment are destroying nature and actually undermining themselves, so shooting themselves in the foot.
Are you feeling optimistic, David?
We're past a tipping point. We're now seeing a conversation changing. You and I talked about this a couple of years ago about why this should be done. Companies and investors are now talking about how they're doing it. We've seen reporters and assessors grow by 50% this year on assessing how nature is in that P&L, as Nicola said. My 7 trillion of harm is because everything we consume is either grown or we extract from the ground. So we're now seeing so many companies doing this and investors. I think the debate is switching into how are we doing it, what are we learning, and what decisions are we taking?
And what do you say? I mean, I know, again, this is something you and I have talked about, the nature technology and the opportunity there. I mean, what are some of the most exciting ways in which this is being proven now and being done now?
Well, the technology is changing and innovating all the time, as we know, but companies are now really looking at a number of areas of their impacts, their dependencies, and looking at how can I reduce resources. Take a really simple one. Can I be more efficient on how I use water? Look at a company like Ecolab in the US worth 70 billion, trading at 34 times multiple. I mean, that is a unicorn times multiple times over that is investing in nature harm reduction. But there are many, many other technologies, everything from electronic circuit board recycling to waste treatment to creating new products from waste products you'd have just put in landfill before. So people are really starting to look at their entire inputs and outputs and think, well, where can I reduce resource? Where can I reuse? Where can I shift that 7 trillion and stop doing as much harm but actually get benefit at the same time as well?
And look, you've got a finance background, David, and you wear that finances hat. Are they seeing the opportunity where they can make good money in this space? Go ahead.
Well, one thing I would say, so the biggest private financiers of nature in the UK are water companies, because they see nature as an essential infrastructure. It is providing flood mitigation, it's providing free water quality mitigation. So all of these services that are being provided, and there is billions going into the space from water, but we're also now seeing, as you mentioned, those big companies like Mars, for example, we just interviewed recently, in United Utilities in the water space, big energy companies that are actually putting real money into this because they see it as essential for their resilience as businesses.
I mean, some of the corporates, the water companies, the energy companies, what about the banks? And what about the fund managers who are looking for opportunities, growth opportunities and money-making projects? What are you seeing there?
So let's talk about the risk and the opportunity equation. They are absolutely looking at this from a risk lens. They are looking at their portfolios and trying to understand in the companies where is the risk on ecosystem services that is not quantified and not there. They really want to understand that. We've seen 30 of the world's largest asset managers all say in their stewardship guidance, we want nature to be assessed, we want to use TNFD, we want you to really understand this. So they're really now focused on this and making sure...
They're good at talking the talk, though, aren't they? I mean, when you actually say to them, OK, look, put your money where your mouth is, what happens then?
Well, it is shifting. We've seen large asset managers shift their portfolio, make allocation decisions based on nature. What was really interesting, we now have 800 reporters. They're in the public domain. We sampled what are they actually doing as a result of this assessment. 40% said they're changing strategy, either procurement, locations, materials, new products. That's a big number. I mean, that is a large percentage of these companies are saying we're implementing change. Now, we're starting, right? Let's not pretend 7 trillion is going to disappear overnight and all become nature positive. But we are starting, we're seeing the technologies, seeing investors. We're seeing banks now input nature risk into their credit and lending models. I mean, that's a big break forward. These are large multinational banks that are starting to do that. So I think it is starting, and we're learning.
Okay, so you talked about the tipping point at the beginning. When's that next tipping point? When do we then get to the next level we need to be at, do you think?
I think the next level is when we start to reclassify nature tech as an investment opportunity.
Okay.
So far, a lot of nature investments and nature funds have focused on restoration and preservation. Really good. Need more of it. But we won't solve this just through bees and trees. We need nature tech in core industrial processes to be an investment class as well.
Go ahead, Nicola.
Well, for me, I think so part of it is about this nature as infrastructure story. So nature, it seems crazy to me that in the UK, we put so much emphasis on infrastructure as important to our growth. But we miss that actually nature is just as vital as roads, energy systems. So I think a tipping point for me is when governance recognise this as a critical infrastructure.
Do the policymakers get it?
So yes and no. So I think they get it and they get the opportunity. I think they still don't get that actually this is essential for our growth in the UK, but also overseas. We just showed some research this week we launched. 1 trillion of dependencies just on rainfall from forests around the world. Yeah. 1 trillion. Yeah. That's just in Europe. Another trillion in China. Another trillion in the US. This is massive. And if that gets undermined, it undermines everything. And as you say, some of the big asset owners are getting this. So we work with Norges Bank Investment Management, and they see this as critical for the risk across their portfolios.
All right, guys, I've got to stop it there. Thank you so much for coming in, to Nicola and to David. Really good to see you again, David. Thanks so much. Right, in a moment, we're going to take a look back at the week's events here in London in terms of what's been achieved and what more could and should have been achieved. Organisers have had to deal, of course, with the extreme heat, which has caused some problems. Let's bring in our reporter, Katie Pilbeam, who's in central London. How are you doing, Katie? Where are you? You're just outside St. Paul, so you're very close to the studios here. How is it out there?
Oh, it's absolutely beautiful, but there's a serious tone to today and the temperatures, because we've even had an event here at London Climate Action Week being cancelled this morning. It was titled Extreme Heat, about the importance of governance and strengthening action around the world, due to take place at the London School of Economics, now not going ahead because of that red warning from the Met Office. And as we say, we've already broken that June temperature of 36.1 that was hit on Wednesday in Hampshire. That smashed through the 1976 level and the highest since records began in 1884. We also know somebody else that was trying to keep his cool this week at one of the climate events. That was the King himself. The aides were trying to keep King Charles cool at St James's Palace, where he was attending an event with the Energy Minister, Ed Miliband, and also Rachel Kite as well, the Special Representative on Climate for the UK. And he was dabbing his face with a bit of a hanky going on there. And as I say, there's some really serious points to be made here. Here in the capital, we've had tourist attractions being cancelled as well, and over in the continent in France, which is the epicentre of this heat wave, temperatures reaching some 44 degrees Celsius.
Yeah. Oh, I'm sorry. Sorry, Katie. Thanks very much. I was just too busy chatting with our next guests on the set here. Thanks a lot, Katie. Stay cool. Right, let's bring in Rhian Marie Thomas, CEO of the Green Finance Institute, and Lisa Sachs, Director at the Columbia Center on Sustainable Investment, who join us to discuss the week's highlights. And look, there's lots to discuss. Let's just start really big picture first. 75,000 people or something thereabouts, over 1,000 events. I mean, it's getting a lot of traction now, this event, right?
It's becoming the place to be, definitely for convening. You and I've spoken about this before, Axel, about, the real value of bringing lots of people together, and does it genuinely lead to action and the sort of investment that we need to see? And, the jury's out on that. But importantly, the sort of collaboration that we're going to need to see to move to this next practical stage of implementation is something that needs to be nurtured. It needs, these relationships are built during weeks like this. So moving from collaboration, moving from, networking to genuine coordination, this has got such an important role to play.
Yeah. Lisa, you've written about whether the policymakers, the investors, whether industry are being asked to do things and deliver things beyond their control. Are they being asked that, or should should we just now assume that they need to get to grips with this and move this process on?
I think that there's a lot of confusion. That's what I've been writing. I think there's confusion about what we're trying to achieve and how we achieve it.
Okay.
I think that there's confusion about how systems transition and what the role is of respective actors and who can actually move the systems.
Right.
I think there's confusion of what we're actually trying to achieve, entity level decarbonization, or actually trying to create a safe, sustainable world. And without that clarity, we are creating a lot of tools and a lot of approaches that I think are not fit for purpose.
Whose responsibility? I mean, it's a really important point. You know, if we can't tell these people what we're trying to achieve or what we want to achieve, then we can't really expect them to start. Whose responsibility is it to create this clear plan, this clear vision, and communicate it properly?
I've been thinking about that actually this week when I keep hearing reference to policy and political will, and I would change that to public and public will, because it's a shared responsibility to have clarity on what we're trying to achieve. And I think the reality is that nobody thinks it's their responsibility and their role. To some extent, they're right, because it is a shared responsibility. I think the most important thing is for everyone to have clarity on what the ultimate outcome is and to recognize that it takes collaboration and coordination, and not to keep pointing fingers or waiting for others to move systems outside of your boundaries.
Rhian, what's the most effective public-private collaboration that we're seeing now, would you say? You know, to Lisa's point, what's really working that you can hold up and say, guys, here's the model, use it?
Well, we heard this morning from Dr. Ma, right, where you're seeing the alignment of industrial policy with the application of finance in China and their now dominance around so many areas of the clean energy transition. I'm not saying that I'm advocating for a planned industrial economy here in the West, but there are certainly lessons that we can take between aligning all the value chain actors behind really well-defined objectives, exactly to Lisa's point. What are we trying to achieve in the real economy? How much is it going to cost? And to whom do we allocate the various risks? And that's the bit where I fully agree we're getting a little confused about that on page 8.
I mean, it's interesting because Marissa Drew from Standard Chartered was talking about nature being in the 5-year plan in China. I mean, fantastic. I mean, but too often we hear the excuses from the politicians here and in Europe and in the US that our system is completely different and it can't work like that over here. And that is the excuse that they use, right?
Yeah. I don't believe that what it comes down to is a political structure. I think what it comes down to is an understanding of the role of planning, period. I don't even think we understand China's system actually very well, because it's not like it's a top-down, centrally planned and mandated all to the ground. It's a thoughtful combination of public tools, public leadership, which is huge, the ability to plan, the ability to think about objectives coherently, and then thinking about the role of markets in achieving those objectives. That can be done anywhere. Have a plan. Think about what one's trying to achieve. Think about the role of the public sector. What are public goods? What are private goods? How does the public sector incentivize and create an enabling framework for private goods? That's what China can teach us, and I actually don't think it's so complicated or a form of governance, actually.
But sort of the political durability of the transition is a really important piece of this, though, right? I mean, and if we can convince politicians that it's durable and that they actually get it, then we're quite a way there.
What makes a transition durable is when it is a better alternative than the one that we currently have. And that's what China shows us. They have managed to achieve energy security, energy efficiency, industrial competitiveness. They've created better systems. So what's durable is not a narrative or a policy. What's durable is a better system.
Rhian, just to finish up with, getting a little bit into the weeds, but in terms of the areas of climate and nature finance that you think are closest to being properly scaled globally, what are those?
Well,
what should we hold up?
Well, we're already seeing the scaling of clean energy technologies such as solar and wind, batteries, grids. I think one of the conversations that has dominated this week is how do we actually replicate for some of the first-of-a-kind technologies, some of the other technologies that we need to see. There's some really exciting stuff happening on the nature side as well. I know that's been such a big theme this week, but we need to keep it practical. We need to talk about supply chains. We need to talk about compliance, market mitigation. There are systems that work. We need to replicate those ones.
Less of an echo chamber this year than it was last year?
Yeah, I still think we could do a better job at talking more broadly, to your point, to the public. It's a bit disappointing that 75,000 super smart people are here in London working on this agenda, and yet if you're not part of that discussion, you wouldn't know it was happening. Let's do better on that next year.
Okay, good. All right, Lisa and Rian-Marie, thank you so much for coming in today, being our final guests of the week, actually. That is it for this series of London Climate Action Week Finance Live. We've had some fantastic discussions and heard from about 50 people, 50 guests, really high-profile guests from around the world, making this a truly global conversation. We hope you've enjoyed the show. Thanks for watching. We'll see you next year.